Hello, and welcome to the latest edition of our Building a Wealth Bridge podcast. I'm really excited about this conversation that we have today. I'm happy to welcome Scott Bosworth, who is the head of the Speakers Bureau at Dimensional Fund Advisors. Good morning, Scott.
Good morning, Zach. Thanks for having me on.
Yeah, thank you for doing this. Really appreciate it. I think we were trying to educate our clients a little bit more on what Dimensional is all about, and I think you are the perfect person to do so. So would you mind just, I think, starting off, maybe introducing yourself, what you do at Dimensional and, kind of how you got there?
Yeah, my name's Scott Bosworth. As you said, I head up our Speakers Bureau. It's a role I actually started in about 2 years ago. And I've been at Dimensional for almost 30 years. I started as a portfolio manager in our Santa Monica office, which back then in 1996, that was our only main office in the U.S. We've since grown quite a bit. We've expanded to Charlotte, North Carolina, and our headquarters where I am is in Austin, Texas. So from portfolio management, I sort of moved into sales. At first, it was institutional sales like pension funds, endowments, foundations, that sort of client base. And then around 25 years ago, I started working with the wealth side of our business. So that's RIAs, broker-dealers, bank trusts, that sort of thing. So the move into Speakers Bureau is something that, I've always been a fairly, I've always liked speaking at our conferences. As you know, Zach, we have a lot of conferences. We've always done that. We actually, to the point where we build our own conference facilities in our main offices. So we host a lot of them in our offices, but we also go on the road and do them in cities all over the country and really all over the world. So after managing one of our teams for a number of years, I decided to step into this new role that hadn't been created yet to sort of manage our speaker team and do a lot more speaking at our events. So it's been a lot of fun.
Yeah, that's great. And yeah, I've been fortunate enough to go to those conferences a few times in Chicago, and every year there's some great information that we end up taking to bring back to our clients. And so thank you for all your help you do with those.
Well, thanks for coming to the conferences, Zach, because without you all, we wouldn't have them.
Yeah, perfect. Well, I think, what I want to start with a little bit is I think a lot of our clients maybe see Dimensional on their, as a line item on their performance reports or on their statements and don't, fully know what Dimensional is. So would you be able to speak to that a little bit of what the company overall does?
Yeah, it's a good question. We get it a lot about, I've never heard of Dimensional, but I've heard a lot of other big money managers like, well, we don't have to name their names. I mean, you can, but, we know who they are and their household names. Dimensional certainly has more public awareness than it did certainly when I started, but even just say 10 years ago. There's a number of reasons for that. One is that we are fairly an institutional focused firm. So we focus on selling directly to the institutions, whether they be RIAs, brokerage firms, banks, insurance companies, pension funds. The end investor, while they can buy our products directly through the ETF channel or their 401ks in some cases, we firmly believe that, to increase your odds of success on the investment front and the wealth front and all that goes into that, having a professional advisor helping you with that is really key to that for the vast majority of investors. One question we get a lot that's related to this is about the executives and leadership and people that have been in Dimensional a long time and sort of have evolved into that place where they need a financial advisor. Many of us have financial advisors, and you would argue that people like the academics we work with, the CEOs of the firm, they have financial advisors. They don't need help with building model portfolios. They probably don't even need help with the behavioral side of things, which is where I think most advisors get a lot of benefit and add a lot of value. But there's so much more that goes into the advisor relationship around wealth management and goals and planning and taxes. That's just not something that we think most individual investors, even very experienced and very educated and very, older folks that have seen it all, they still can benefit greatly from that. So because we're not, sort of targeting the individual investors in most cases, our name isn't out there. We're not doing TV ads like some of our competitors are. We're not, sort of in the the social media sphere quite to the same extent. Now, that said, we are trying to get the word out. I mean, largely, we do want people to know who Dimensional is, but the goal there is always to sort of direct them to professional advice. And if they find the value in that, then that's probably going to be a win-win, right? It's great for Dimensional because we get better clients. We get clients that have better experiences, and of course, we support the advisor community.
Yeah, perfect. No, I think, I mean, I've only been in this industry for 10 years or so, but it seems like there's been a huge evolution towards more advice versus just, investment management, highest returns. There's so much more that goes into it. Even, I met with somebody not too long ago who, for his whole life, kind of did everything himself and just wanted us there, in case something happened to him, to make sure, give him the comfort that his family was going to be okay, that it wouldn't be too much stress on his family. And so there's all different reasons why people want to work with an advisor.
Yeah, that's very true.
Yeah, and I think I guess I want to backtrack a little bit. It just with Dimensionals, the history of index funds, how Dimensional was a part of it. I'll do a plug for the Tuning Out the Noise is a great documentary for that Dimensional worked with. Oh, I'm forgetting the name of the person who produced it.
Errol Morris, the director.
Yeah. Who is it was great. If anybody wants to learn a little bit more about Dimensional, I think that'd be a great place to start. But I think going back to the 1920s or so, before really indexes were even a thing, it seems like institutional asset managers, didn't really have any way of, tracking their performance. And that's when indexes came about. And I think in the 50s or 60s was when the S&P 500, just the index, came about. And Scott, I'm sure you probably can speak a lot better and more eloquently than I can on this. But I know in the 70s was when Ransom Cook at Wells Fargo hired, I think, Mac McClellan to start the team to start index investing. And Dimensional kind of, is connected to that all along the way.
Yeah. Yeah, it's a cool story, and it's told in great detail in the movie that you mentioned, Tune Out the Noise. And that's an example to your previous question about the efforts we are making in terms of getting the word out around Dimensional. Now, it's not a Dimensional advertisement, but it is a cool documentary about the evolution of financial science, and Dimensional plays a big part in that. The way I like to describe it is if you go back to the 70s, which is when most of this started at Wells Fargo, as you mentioned, they were compiling a lot of data. They were experimenting. I think the first index approach was actually at Wells Fargo by who eventually would found Dimensional, David Booth, and you mentioned Mac McCown's name. They were kind of the part of that team of pioneers that sort of started experimenting with this idea of building an investment solution for institutional clients that didn't rely on stock picking, right? So how can you do that? Well, there were indexes available, so maybe trying to recreate those indexes in some way. They compiled a lot of data. As the story goes, Jack Bogle caught wind of this work at Wells Fargo, and Mac McCown and his team said, yeah, give him the data. Let him run with it too, because they weren't concerned with retail investing or direct-to-consumer investing, whereas that was obviously Vanguard's business. So I think that fund, I don't know the exact date, but that S&P 500 index fund launched in the 1970s. So it's oftentimes missed in that Dimensional was a pioneer in indexing, because today, and since 1981 when we were founded, we haven't been an index shop. We take some of the principles that were learned from that pioneering effort, but what we realized is in many segments of the market, indexing was very inefficient. And it turns out even in very liquid segments of the market, there is something you're sort of leaving on the table by focusing exclusively on tracking error, which is what an index's job is, versus focusing on total return, which I think, as long as you're willing to sacrifice looking a little bit different from the market, you can have you have a higher probability of having a better investment experience by following a more flexible approach than something rigid like indexing.
Gotcha. Yeah, I think that's really true. I think a lot of people maybe get caught up in the very, very low expense ratios of some index funds versus what Dimensional is doing, or even the active funds. But I think maybe diving a little bit more into that would be helpful. Of index or passive versus active, and kind of how dimensional fits in, maybe kind of the goals of the different approaches, and how they're different, and how dimensional thinks about things?
Yeah, I think it's a great question. It's really at the heart of kind of why we do what we do, and how we do what we do, and how we position it versus our competitors, whether they be active funds, index funds, or some combination of the two. There is a kind of a I don't have a graphic to share, but if I did, I would maybe sketch it or show a slide. But I'll walk through kind of a grid sort of concept, and how we think about where dimensional differs, and why that's a benefit to investors, users of our investment solution. So if you think about, there's three elements that we think are they encapsulate sort of the investment experience as you think about it from our perspective as an investment manager. There's essentially the market that we're interacting with. Every active manager, every indexer, every money manager in the world has to interact with the market. They have to buy and sell securities over long periods of time. So what is a market? It is a collection of prices. Really, that's really what a market is. It's prices. So we think about prices a little bit differently than our competition does. If you think about it, I like to use one-word descriptions. An indexer sort of, what I would say is largely they ignore price, except for that one period. Maybe it's once a year, or maybe it's twice a year, when that index reconstitutes. So on that date, they care a lot about prices. They care so much about prices, they want to get the exact same price for their securities, whether they're buying them or selling them, as the index gets. They really don't care if it's too high or too low. They just want to get the same price the index gets, because their job is to track that benchmark. So the word I use for indexing when it comes to the market or prices is this concept: they largely ignore prices. An active manager, by contrast, looks at the market and says, "Oh, the market's got it wrong in certain places." So they're largely disagreeing with prices. They think they've got a better sort of analysis tool or a better gut instinct, and they're going to use that instinct to find undervalued securities, things where prices are too low, or avoid things or sell things where prices are too high. So to me, it's ignoring them or disagreeing with them. Whereas at Dimensional, when we think about interacting with the market, we embrace it. Prices have really valuable information about expected returns, and that gets updated every day. It gets updated every second of every day. So prices are constantly changing, and yet active managers largely disagree with those prices, whereas indexers largely ignore all that information they're getting. The second one is this idea of premiums, which you sort of exposed already, this idea that not all stocks have the same expected return. So what mechanism would inform the differences in expected returns? And to me, that's this premium argument. And of course, those differences come from the prices that the market is setting these stocks at. And remember, there isn't the market. There isn't some sort of omniscient entity out there that we call the market that we're all interacting with. What people have to remember is the market is all of us. We're buying and selling, and that's how prices get set. There isn't some cabal or secret star society that's setting prices for us. So it's supply and demand, and trusting that process with some controls. I mean, we don't blindly trust every single price in the market. We have a massive intelligence and data analysis effort going on at Dimensional constantly to manage that data, understand it better. And we have exclusions. We have all sorts of rules in place that we're not blindly following every price all the time. But when you think about premiums, again, going back to indexes, what I think indexes are sort of susceptible to is this idea of drift. Because they're only setting their portfolios periodically, maybe once a year or once every 6 months or once a quarter, between those periodic rebalances, they could drift away from the premiums they're trying to capture. Maybe it's a small cap index, maybe it's a value index. An active manager, I would say that their approach to premiums is very subjective. One manager may say, well, this XYZ stock is definitely a growth company. I mean, look at the metrics. And some other manager who's a value manager may say, yeah, it kind of looks like a growth stock, but we think of it as a value stock because it's relative to some other instinct or intuition they have. So you can have very different definitions, and a lot of subjectivity comes into the the marketplace when you think about dealing with it in a non-systematic way. And then at Dimensional, the way we think about premiums is just a laser focus on this, the idea of what causes differences in expected returns and how can we build robust portfolios that capture those differences without getting away from diversification, without imposing too high a cost in capturing those. So there's all these trade-offs that we take into account every day. And then the last one is this idea of process or implementation. You might have noticed all three of those start with a P: prices, premiums, process. I know we're very clever at Dimensional, Zach, but this is the implementation piece. This is this is where the rubber meets the road. My first job at Dimensional was as a portfolio manager, and this is what we did. It was the implementation of these ideas and buying and selling securities in the most efficient way we could to deliver most of that, or as much of that expected return from the markets to our clients as possible. So again, when I think about an index, it's very rigid. I've already explained that. Their methodology is extremely rigid because that's what they're paid to do. They're paid to deliver something very, very close to the index return. And any deviation from that, even if it's a positive deviation, by the way, would be considered kind of a failure. With active management, it's this urgency, right? I mean, I think we can, if you have a good idea, you want to implement that idea before anybody else figures it out. You've discovered something that's undervalued or overvalued. You have some sense of urgency to get into the market and do it as quickly as possible. At Dimensional, we've got that one word that you've heard a lot if you've been to our conferences, Zach, and that's flexible and patient. Those are two words. I'll start with flexible. We want to be really flexible when we go to the market, because if you have urgency or very specific demands, you lose your negotiating power. And if you don't have patience and if you don't have flexibility, you have to take what the market's going to give you. Whereas at Dimensional, we have this, I use the metaphor of a sandbox. We have a sandbox that we play in, so we can't go just anywhere. But we, with a particular portfolio, we have a particular set of securities that we're looking at that day to buy or sell, and we can be very selective and very patient, and we don't have to do everything at once. As a matter of fact, that's the last thing we want to do. So that is a very big differentiator between how Dimensional approaches the market. Those 9 words, that 3x3 grid is a pretty universal way of thinking about how Dimensional stacks up against our competition.
Fantastic. Yeah, thank you for that. I think there was one kind of analogy that I remember hearing at one of those Dimensional conferences, talking about the difference of active versus passive and how Dimensional kind of fits in. And I drive 45 minutes or so to work every day, and an index approach to driving maybe is like printing out MapQuest and having that in your car, and you have your directions that maybe they're a little stale, whereas an active approach would be me kind of saying, I don't agree with those directions. I know if I make this detour, or get off at this exit, or go down this side street, I'm going to get there faster. And I don't know if maybe there was a car accident on one of those streets, or there's road construction or something like that. But I think, I'm going to take a risk and, try and outperform. Whereas Dimensional maybe is, having GPS on in your car the whole time that is constantly recalculating and seeing those road closures, seeing traffic, and giving you the best possible way to get to your destination. And for some reason that always just kind of hit home with me and that is how I drive to work with GPS out every day.
Yeah, I think that's a great analogy. That a journey is always a good analogy for me. I mean, and Zach, you look pretty young. I'm surprised MapQuest was the thing that you referenced to. That's kind of old school. That's like you could have said a triptych from AAA. That would have been even better. Yeah. But I like that analogy, and I think there's maybe one other element I would add to that, which is, we're not, even with the GPS on, we're still, we have experience. We've done this route before, and sometimes you might know something that the GPS doesn't know. That may be a bad metaphor. What I'm trying to get at is, we don't disagree with market prices. That's not what I'm getting at. What I'm getting at is there is a human element that I think is very important, that requires some judgment when it comes to the right path, the path of least resistance, and avoiding those massive backups or those massive delays. So sometimes a human element is a fairly important addition to that analogy.
Right. Absolutely. And I think just as me, when I think about those different, index versus active, I think, as Scott said, the objective of a index fund is to track the benchmark. Whichever benchmark there is, there's hundreds, if not thousands, of different indexes all around the world, and their goal is to track it exactly. Using the S&P 500 as an example, that's probably the most popular index. They do their reconstitution. If there's a quarterly that they announce different additions into their fund, and they announce it maybe a week in advance. And it seems like leading up to that reconstitution date, there's all sorts of different trading, and those index funds have to buy the new stocks that are going to be included, maybe at not the best time. Maybe they're go up in price because there's more volume, because everybody knows they're going to be included in the index soon. And I think that's something that Dimensional is, Scott, as you were saying, like the flexibility of, we don't have to own it on that specific day. We have, a lot of flexibility into when we make that purchase, and maybe allows Dimensional to buy things at better prices.
Well, yeah, you're kind of getting into a little bit of the weeds on trading rules, but one of the trading rules, to your point, is if a stock is a stock that's one of those stocks that's going to be added to an index or removed from an index, and it's coming up. And, as you said, the index rules are fairly easy to replicate, so people can obviously front run those additions or subtractions. Sometimes they're not additions and subtractions, though. Sometimes it's a stock moving from one index into another index, whether it's, the S&P 500, maybe that stock is being added from the S&P 600, a small cap, or the S&P 400, which I think is a mid-cap index. I'm not an expert in the index reconstitution rules. What I do know, however, is they change periodically, and sometimes they change their rules, right? They'll, generally speaking, from what I understand in the industry, indexes like to reconstitute as little as possible, because every time they reconstitute, that's a cost that the indexers have to bear. So, it's like they wouldn't want to reconstitute every day. They could, in theory, just reconstitute their portfolios every day. That would eliminate the drift part that's a problem with indexing, but it wouldn't eliminate all of the problems with indexing. You still have a very rigid process. You're still largely executing market on close orders, whether you're buying or selling. So those are still issues that would remain. Although I don't expect indexes to ever adopt a daily reconstitution, because that would one of their goals as an index provider is you want to entice people to track your index versus somebody else's index. And by doing so, you want to have rules that make it a little bit easier for the money managers to follow. So there is a little bit of a feedback loop there between the index managers and the index providers. But that is another important element to think about. When you're an index manager, you're actually outsourcing your portfolio management in terms of what you're buying and selling, when you're buying and selling them, how much you're buying and selling. You're outsourcing all that decision to a third party that isn't a money manager largely. They're an index provider. That's their primary role. So those are all great points. I love your analogy on the journey too. But that was my 2 cents on the reconstitution bit.
Perfect. And I know I mentioned the index goal is to track the market, whereas an active manager, their goal is to beat the market, and Dimensional is trying to beat the market. They're just going at it in a little bit of a different way. And I think I kind of skipped over a part of, with the origination of Dimensional and the ties with the University of Chicago, which in my mind, in terms of business schools, and they are probably the best school when it comes to investment research. Could you speak to that a little bit, and then maybe we'll touch on the premiums and wrap it up?
Yeah, sure.
Yeah.
Well, as people might know, I mean, and I think the University of Chicago has a prominent role in the beginning of that movie, but it's where David Booth went to business school, and where he met Gene Fama, who was, I think, essentially the first person he reached out to when the idea to found Dimensional kind of popped into his head. So Gene and David were, both at the Booth School. It wasn't called the Booth School then. That came much later. But, then they went down the hallway in the University of Chicago and, enlisted Myron Scholes and Merton Miller and others to join the board of directors for this yet to be established mutual fund company. So they kind of got their ducks in a row early. But when you think about the University of Chicago is a think tank in some ways, and so great ideas, Nobel Prize winning ideas were coming out of that school and continued to come out of that school for years after Dimensional was founded. So there was an academic underpinning that was specific to this pursuit of sort of how markets work and how can you manage money the most effective way. That was, at that time in 1981, a very revolutionary approach to money management. It was not active stock picking, but also not indexing, which even then in 1981 was in its infancy. But it was this idea of capturing the returns in a market in a broad way, but having this flexible approach. It turns out that flexible approach, and with the combination of focusing on stocks with higher expected returns based on the academic research, that is a way to outperform markets. That is in our view, a more robust way to outperform markets. It's systematic. It has evidence to back it up. But like any risk premium, it doesn't show up all the time. Because if it showed up all the time, it wouldn't be called a risk premium. It would be called a mistake or an arbitrage opportunity. And those things don't last very long. When they arise in the markets, managers go in there, hedge funds, active managers, and they squeeze that stuff out very, very quickly. It's very difficult to find those kinds of anomalies today, given how much money is being managed in the markets.
Yeah. No, thanks for diving in. I think the origination and the amount of academic genius, I guess we'll call it, that are kind of powering Dimensional from the start is some of the best parts of it. It's very impressive, and just in studying all this stuff in school, hearing the different names of Scholes and Eugene Pharma and Ken French and David Booth, and it's very impressive. And it seems like Dimensional is constantly a good amount of time and money gets put into research of what more can we do to improve upon this process, which I think is something that us as advisors love to hear.
There's a cool quote I'll share on this subject before we move on to the next one. But I think it was Gene Fama who said years ago, he said, in the implementers, the money managers, they've been using my research for years. Dimensional is the only one that actually asked me what I thought about it, which I thought was an interesting sort of it's an insight into his psyche. It's an insight into the relationship that he and David had early on, which, David wasn't just going to take this academic research and run off to to his headquarters and do it in a vacuum. He wanted their input, and that ended up being extremely valuable. I mean, Gene Fama and Ken French are still involved with the firm today, and that's been 45-ish years that we've had that relationship with those academics. Some of them, the ones that have been there the longest.
Right. That's fantastic. And lastly, I feel like when I talk about Dimensional, I always bring up more of a systematic investment manager that tilts portfolios to areas of markets with proven higher expected returns over long periods of time. And I think you kind of hit on that things come in and out of favor over times, and when maybe the premiums are in favor, they really show up. And maybe there's periods where they're not there, but we want to make sure we're taking a long-term time horizon. Would you mind just hitting on some of those premiums, I guess, in regards to the stock premiums more so than the bond ones?
Okay, sure. Yeah, I mean, I'll try to keep it fairly simple, but there are, the three premiums that we focus on. Really, there's four, because the equity premium, meaning stocks versus, a risk-free asset. I mean, that in and of itself is a premium that doesn't show up all the time, right? I think in the U.S. at least, and probably similar in other countries, but the odds of having a negative experience on that premium, so that premium being negative, is about 1 in 4, meaning, on an annual basis, the equity premium may be negative on average 1 out of every 4 years, which is probably a more frequent, more higher frequency than most investors might assume. Maybe not, but I think that's worth pointing out. But then within stocks, you've got the size premium, you've got the value premium, and you have what we call the profitability premium. And the premiums are all related by one common thread, which is price. And David Booth had a great quote. Again, I think he said this years ago. He said, it's always been about the price. And the way he would say it is he said, if you have two stocks, all else equal, buy the one with the lower price. If you have two stocks with the same price relative to their net asset value or net book value, buy the one with the lower price. If you have two stocks with the same cash flow, buy the one with the lower price. Now, you may have noticed it, you may not, but that quote addresses each of the three premiums in I would say oversimplified way, but a way that's I think can resonate with folks. So, all else equal, a small stock is going to have a higher expected return than a large stock. Doesn't mean it's always going to have a higher return after the fact. It's just in expectation, it has to be that way, because if those two stocks had the same expected return, no one would buy the riskier one. No one would buy the smaller one. Why buy a grocery store with one outlet when you could buy a grocery store with 1,000 outlets? The one with more outlets has a better diversification. It's bigger. It has more assets to fall back on if times get tough. So that's just kind of, that I think makes intuitive sense. The idea of a value stock having a higher expected return than a growth stock, that makes intuitive sense to most people as well. The profitability one gets a little bit trickier because people think of, well, higher profitability, that's a good thing, not a negative thing. So why would that have more risk? But I think what is oftentimes forgot or lost is that it's a relative measure. So if you just looked at all stocks and didn't have any relative measure and just said, just buy the stocks with the highest profitability, without any kind of controls on that, you would end up with a portfolio that was predominantly large cap versus small and predominantly growth versus value, which is kind of the opposite of what you'd want if you're trying to outperform markets using sources of expected returns. So we look at profitability within a segment of the market. So profitability within small value stocks, profitability within mid-cap growth stocks. So it's all relative to where they sit in the market. That's a simplified way of looking at it. But profitability really gets to, if two stocks have the same expected cash flow, but one of them is trading at a lower price than the other one, that's the market telling us something about the riskiness of that cash flow. And there should be some compensation involved with owning that stock versus owning a stock with a higher price and the same cash flow. And that's kind of what the risk premium is trying to capture.
Sure. That's great. Yeah, thank you for saying. And I think one way that I kind of think about it, it's not we're putting all of our eggs in one basket. It's more of just tilts. And I think also at one of those conferences, I heard an analogy of, if you're playing baseball and you're on defense against a left-handed hitter who always pulls the ball to right field, you're not going to put all 9 of your defenders in right field. You're going to maybe tilt the center fielder a little bit closer, maybe shift a little bit more to right side. But, if he somehow hits the ball to left field, you're not going to be completely offsides, which is kind of how I think about the tilts of the different premiums.
That's a really good analogy. And actually, Zach, I've not heard that one before, so I don't think I was at that. I must have missed that conference. That was that's a really good way of thinking about it. If you understand baseball, right, and the shifts, that's a really good way to think about it. And it brings up something that I failed to mention earlier, which is it can get lost in all this conversation around the premiums that we don't really view these as like, oh, small stocks are better than large stocks, or that you want to somehow avoid stocks with lower expected returns. We want to buy, with some limitations, we want to buy all the stocks in a market. It's how you tilt, to your point, how much expected return over the market return are you trying to capture? And that will dictate how you build that portfolio. The analogy I often give when you think about our role at Dimensional versus your role as the advisor is we build these car parts, and we think we build the best car parts in the industry. And then you're the one that has to build the car for each of your clients, because not every client has the same needs, the same goals, the same risk tolerance. So we're sort of the mechanic, if you will, and you're sort of the manufacturer. And then to take that analogy a step further, you then get in the car with your client and help them drive it, because the behavioral part, trust me, the behavioral part is a really big part of the value add of a good advisor.
Yeah, I had not heard that one, but I think that's a great analogy, and a great way to end this. And Scott, thank you so much for your time. I think our clients will get a lot out of this. And thank you for everything that you and everybody at Dimensional does for our firm and for our clients. Been a great partner, and look forward to working with you all for many years to come. But thank you.
Yeah, thanks, Zach. Thanks for having me on. I appreciate it. It was a lot of fun.
Yeah, it was great. All right. Thanks, Scott. Take care.